Stock chart patterns are an important trading tool that should be utilized as part of your technical analysis strategy. From beginners to professionals, chart patterns play an integral part when looking for market trends and predicting movements. They are useful especially on short-term traders and also long-term investor as well. They can be used to analyze all markets including forex, shares, cryptocurrencies, commodities and more. Trading chart patterns often form shapes which can help predetermine price action, such as stock breakouts and reversals. Recognizing chart patterns will help you gain a competitive advantage in the market, and using them will increase the value of your future technical analyses. Before starting your chart pattern analysis, it is important to familiarize yourself with the different types of trading charts. Before getting into the intricacies of different chart patterns, it is important that we briefly explain support and resistance levels. Support refers to the level at which an asset's price stops falling and bounces back up. Resistance is where the price usually stops rising and dips back down. The reason levels of support and resistance appear is because of the balance between buyers and sellers, or demand and supply. When there are more buyers than sellers in a market, or more demand than supply, the price tends to rise. When there are more sellers than buyers, which means more supply than demand, the price usually falls. As an example, an asset's price might be rising because demand is outstripping supply. However, the price will eventually reach the maximum that buyers are willing to pay, and demand will decrease at that price level. At this point, buyers might decide to close their positions. This creates resistance, and the price starts to fall toward a level of support as supply begins to outstrip demand as more and more buyers close their positions. Once an asset's price falls enough, buyers might buy back into the market because the price is now more acceptable, creating a level of support where supply and demand begin to equal out. If the increased buying continues, it will drive the price back up towards a level of resistance as demand begins to increase relative to supply. Once a price breaks through a level of resistance, it may become a level of support. Alright, now that you understand support and resistance levels, without further ado, let's start with the top 10 chart patterns every trader needs to know. Number 1, Head and Shoulders. Head and Shoulders is a chart pattern in which a large peak has a slightly smaller peak on either side of it. Traders look at Head and Shoulders patterns to predict a bullish to bearish reversal. Typically, the first and third peak will be smaller than the second, but they will all fall back to the same level of support, otherwise known as the neckline. Once the third peak has fallen back to the level of support, it is likely that it will break out into a bearish downtrend. Number 2, Double Top. A double top is another pattern that traders use to highlight trend reversals. Typically, an asset's price will experience a peak before retracing back to a level of support. It will then climb up once more before reversing back more permanently against the prevailing trend. Number 3, Double Bottom. A double bottom chart pattern indicates a period of selling, causing an asset's price to drop below a level of support. It will then rise to a level of resistance before dropping again. Finally, the trend will reverse and begin an upward motion as the market becomes more bullish. A double bottom is a bullish reversal pattern because it signifies the end of a downtrend and a shift towards an uptrend. Number 4, Rounding Bottom. A rounding bottom chart pattern can signify a continuation or a reversal. For instance, during an uptrend an asset's price may fall back slightly before rising once more. This would be a bullish continuation. An example of a bullish reversal rounding bottom, shown below, would be if an asset's price was in a downward trend and a rounding bottom formed before the trend reversed and entered a bullish uptrend. Traders will seek to capitalize on this pattern by buying halfway around the bottom, at the low point, and capitalizing on the continuation once it breaks above a level of resistance. Number 5, Cup and Handle. The cup and handle pattern is my favorite and most effective pattern in my opinion. It is a bullish continuation pattern that is used to show a period of bearish market sentiment before the overall trend finally continues in a bullish motion. The cup appears similar to a rounding bottom chart pattern, and the handle is similar to a wedge pattern, which is explained in the next section. Following the rounding bottom, the price of an asset will likely enter a temporary retracement, which is known as the handle because this retracement is confined to two parallel lines on the price graph. The asset will eventually reverse out of the handle and continue with the overall bullish trend. Number 6. Wedges. Wedges form as an asset's price movements tighten between two sloping trend lines. There are two types of wedge, rising and falling. A rising wedge is represented by a trend line caught between two upwardly slanted lines of support and resistance. In this case, the line of support is steeper than the resistance line. This pattern generally signals that an asset's price will eventually decline more permanently, which is demonstrated when it breaks through the support level. A falling wedge occurs between two downwardly sloping levels. In this case, the line of resistance is steeper than the support. A falling wedge is usually indicative that an asset's price will rise and break through the level of resistance, as shown in the example below. Both rising and falling wedges are reversal patterns, with rising wedges representing a bearish market and falling wedges being more typical of a bullish market. Number 7. Pennant or flags. Pennant patterns or flags are created after an asset experiences a period of upward movement, followed by a consolidation. Generally, there will be a significant increase during the early stages of the trend, before it enters into a series of smaller upward and downward movements. Pennants can be either bullish or bearish, and they can represent a continuation or a reversal. The above chart is an example of a bullish continuation. In this respect, pennants can be a form of bilateral pattern because they show either continuations or reversals. While a pennant may seem similar to a wedge pattern or a triangle pattern, explained in the next sections, it is important to note that wedges are narrower than pennants or triangles. Also, wedges differ from pennants because a wedge is always ascending or descending, while a pennant is always horizontal. Number 8. Ascending triangle. The ascending triangle is a bullish continuation pattern which signifies the continuation of an uptrend. Ascending triangles can be drawn onto charts by placing a horizontal line along the swing highs, the resistance, and then drawing an ascending trend line along the swing lows, the support. Ascending triangles often have two or more identical peak highs, which allow for the horizontal line to be drawn. The trend line signifies the overall uptrend of the pattern, while the horizontal line indicates the historic level of resistance for that particular asset. Number 9. Descending triangle. In contrast, a descending triangle signifies a bearish continuation of a downtrend. Typically, a trader will enter a short position during a descending triangle, possibly with CFDs, in an attempt to profit from a falling market. Descending triangles generally shift lower and break through the support because they are indicative of a market dominated by sellers, meaning that successively lower peaks are likely to be prevalent and unlikely to reverse. Descending triangles can be identified from a horizontal line of support and a downward sloping line of resistance. Eventually, the trend will break through the support and the downtrend will continue. Number 10. Symmetrical triangle. The symmetrical triangle pattern can be either bullish or bearish, depending on the market. In either case, it is normally a continuation pattern, which means the market will usually continue in the same direction as the overall trend once the pattern has formed. Symmetrical triangles form when the price converges with a series of lower peaks and higher troughs. In the example below, the overall trend is bearish, but the symmetrical triangle shows us that there has been a brief period of upward reversals. However, if there is no clear trend before the triangle pattern forms, the market could break out in either direction. This makes symmetrical triangles a bilateral pattern, meaning they are best used in volatile markets where there is no clear indication of which way an asset's price might move. An example of a bilateral symmetrical triangle can be seen here. In summary, all of the patterns explained here are useful technical indicators which can help you to understand how or why an asset's price moved in a certain way, and which way it might move in the future. This is because chart patterns are capable of highlighting areas of support and resistance, which can help a trader decide whether they should open a long or short position, or whether they should close out their open positions in the event of a possible trend reversal. Just remember, there is no one best chart pattern, because they are all used to highlight different trends in a huge variety of markets. Often, chart patterns are used in candlestick trading, which makes it slightly easier to see the previous opens and closes of the market. Some patterns are more suited to a volatile market, while others are less so. Some patterns are best used in a bullish market, and others are best used when a market is bearish. That being said, it is important to know the best chart pattern for your particular market, as using the wrong one or not knowing which one to use may cause you to miss out on an opportunity to profit. The most important thing to remember when using chart patterns as part of your technical analysis is that they are not a guarantee that a market will move in that predicted direction. They are merely an indication of what might happen to an asset's price. Thank you for watching. Click subscribe and hit the bell icon to never miss an update from us.